disclaimer, I'm not going to be speaking, I'm not going to be speaking as a fund manager in this session. I'm going to be sharing personal experience. So please consult your personal financial advisor based on everything that I say, because I'm really just sharing personal experience and not speaking in my professional capacity. So what I wanted to do was to just share maybe some of the lessons I learned on my road to financial independence. So I became financially free by the time I turned 40. And there are certain things that I did along the way to arrive at that. So I wanted to just share what those lessons were, and maybe someone can kind of glean from the lessons and adapt based on your personal circumstances. So I've prepared a bit of a few slides just in case the team wants to share the slides at the end of the session, because I know some people might not be able to attend. So let me just... so I'm going to talk about mindset shifts. I'm just going to skip through the content since I'm going to share. I think the first thing in creating wealth and in achieving financial independence is to make a decision. Do you want to be rich or do you want to be comfortable? And neither of the two options is better than the other. But because what it takes to be rich is completely different from what it takes to retire comfortably and vice versa, it's good to kind of know upfront what your motivation is. For some people, it could be they want to become a philanthropist. For some people, it could be they want to maybe finance, the kingdom of God. You need to just have a paradigm in your mind. Why do you want to make money? Why do you want to become financially independent? And then you proceed from there. Because like I said, the skill sets are completely different. The way you approach retirement planning is completely different from the way you approach maybe early financial freedom, what you call financial independence, retire early, FIRE. So they're two completely different mindsets. So if you can kind of just spend a minute or so reflecting. I'm going to give you a few seconds before I move into the next session. At the stage of your life now, what is your primary motivation for creating wealth? Take a few seconds, just reflect, just try to think, what is motivating you? Is it to take care of your children? Maybe to give them, an Ivy League education? Is it your parents? Is it yourself? Just take a few minutes and just jot down some notes, because whatever path you choose kind of determines the next 5 years of your financial independence journey. You will need seed capital. So unless you're 21 and you're just starting your first job, you don't have a lot of time. So if you're young, you have at least 20 years to build wealth gradually, and you can just really compound over time. You don't need a lot of money to start. You can just, have small amounts that you're growing and compounding. But once you kind of miss that window, and you've not built a financial structure, so maybe you're starting at 35, you're starting at 40, the context changes. You don't have that time to compound, So what you then need to do, there are only a few variables in building wealth. There's time, there's seed capital, and then there's your risk profile. Those are the variables. So if you don't have time, then it means you only have two variables that you can work with. Your risk profile, which invariably determines your return on investment, because risk and reward are directly correlated, and the amount of seed capital you put down up front. So those are the only two variables you have left once you're not in your 20s. And those are the two variables and the two parameters that you're going to be working with. So I typically say that in terms of your seed capital, you kind of need to have at least $5,000 to start with. And the question is, where do you find the $5,000? It can come from your job. So if you earn, a good salary, you can decide, I'm going to set aside 10% of my salary every month until I hit, that $5,000. It could be from your business. You could say, oh, the profits that comes to me as a director, my dividends, whatever, I'm going to, set aside $5,000. It could be an inheritance. Maybe you've just come into some money and you're wondering, oh, what can I do with it? That's also a source of seed capital. This is tax season in the US. Some people are going to get tax refunds. That's also a source of significant seed capital. It could just be savings. Maybe if you have some money you've set aside as savings. And it could also be a side hustle. So it could be that maybe you have a job, but you also have a consulting business on the side, or you sell some goods and services on the side. That could also be a source of seed capital. But just remember what I said. Once you're past your 20s, you don't have the benefit of time. So what you then need to do is increase your starting capital so you can reduce the amount of time it takes to build wealth. The third thing is investment planning. Decide what are your investment objectives. Like I said, do you want to, fund the kingdom? Do you want to build an endowment fund for your children? Do you want to be able to afford exotic vacations around the world? Just determine what the objectives are. Determine your risk profile. There's several platforms online that, just answer a couple of questions. I'll post one in the chat maybe later on. Once you answer a couple of questions, you get your risk profile. And what that does is that it also gives you a sense of the kind of investments that are suited for you. So whether you have a low, medium, or high risk profile. Seed capital should be in your investment plan. Time frame, how long do you have to invest? Is it 5 years, 10 years, 2 years? And then once those elements are in place, it's easy for any financial professional to help you develop an investment plan. So sometimes you may need to either use templates online. It could be a video. There are a lot of YouTube videos that can take you through the process. I can also help you develop an investment plan. So really, any financial professional can take you through the process once they have these 4 variables. You will need a tribe. So it's easier to create wealth when you have you're pulling your monies together. So on your own, you may only have 5,000, but imagine if you had 10 people coming together to put 50,000. You had 20 people coming together to put 100,000, and each person just brings 5,000. And that's why people use investment clubs. People set up LLCs with their friends, with their family members, so that they can fund an investment objective or an investment project. It could just even be your cousins, your friends, people who are like-minded and who want to go on this journey of wealth creation with you. Because what that does is that it gives you access to deals that you would ordinarily not be able to access with your own limited capital. But by the time you pull that capital together, you're able to access opportunities. So I belong to an investment of about 3,000 family and friends, and together we control about $30 million in assets under management. So that's the power of community. When you come together, you're able to then access different things that you may not be able to access on your own. So you do need a tribe. You can't go it alone, especially again, because for some, you may want to just fast track the wealth process. Be mindful of taxes. Get your tax planning done at the beginning of the year so that you can plan for the forthcoming year. And this is just to reduce how much you're paying in taxes so that you can save more disposable income for investment, and you can get more tax refunds at the beginning of the year that you can use for investment. So typically, once you sit with a tax professional, there are a lot of free tax clinics that you can just walk into. They'll give you tax planning services for free. You don't need to pay for it. And what they just do is look at your personal circumstances and advise, on different ways you can structure things or different ways you can file your taxes in such a way that you're not putting so much of a burden on yourself and you're not paying, taxes that you don't need to pay. So they'll give you that strategic advice so that you just have more disposable income for investment. And even in terms of investment, they'll guide you on how to defer things like capital gains tax, such that you're not paying so much tax on your investment as well. Probate, this is for those who want to pass on their wealth to their children. So be mindful of the fact that depending on the jurisdiction that you live in, there are only a few investment products that will not be frozen by the government immediately you die. And that's because the government wants to get its taxes before the monies are finally released to your family. Universal life insurance is good because that way you can literally put a lot of your cash value, a lot of your investment income. Once you've made investments, you can put that into a universal life insurance plan, especially one that benchmarks the S&P 500. So that way you're earning money on your savings. You can borrow against it. So it just has a lot more flexibility. And if anyone wants to learn more about that, please just let me know, particularly if you're in the US. Also having a trust such that your real estate is owned by your trust, your assets are owned by your trust. So again, if you ever die, your children automatically have access, or your beneficiaries automatically have access to that trust. You're not having to go through a lot of probate issues. And then finally, it's good to have a will, have an updated will. Again, it's just really looking into the future and taking care of your beneficiaries, taking care of those who depend on you, so that in the event anything happens, your affairs are really in order, and people are not having to look for documents and having to look for things all over the place, because you've done a proper will with clear instructions. If you run a business, it's good to have an operating agreement. Again, it's just so that if you have co-founders, if you have investors, if anything happens to you, it's clear, who gets your shares. It's clear how you want that, distribution process to take place. It also helps in case you ever fight with your co-founder or fight with any of your investors, just having a clear operating agreement, because for a lot of people, your wealth is in your business. So if you're an entrepreneur, you find that a lot of your wealth is actually locked inside your business. And typically until you have an investment raise, you can't unlock that wealth. So until someone invests in your business, it's very difficult to extract the wealth from your business beyond just the regular profit and the regular dividends. So having an operating agreement just helps, because if that is your primary backup in terms of wealth, and that is your primary safety net in terms of wealth, you want to protect it such that it's clear who owns what in the event of a dispute, what happens, and also how your stake in the business will be passed on to your heirs once you die. Finally, I'm going to round up with where the money is. So just to give a sense of some of the places I'm investing and some of the places that can help fast track wealth. And then again, a caveat is this is not investment advice, so please consult your investment advisor. I'm just going to talk about what I am doing personally. And then I'll open it up for questions so that I can really just speak to the things that people want to know. So for 2024, I'm doing a lot of investing in equities and commodities, and really it's just because of the data. Anytime the Fed increases interest rates, it's cheaper to buy stocks. Also because the US economy is booming. So really for me, I'm doing a lot in terms of just the equity space, the commodity space. Commodities for me, because anytime there's a war, commodity prices go up. And right now we have 2 wars going on: Ukraine, Russia, Israel, Palestine. So anytime the world is in crisis, commodity prices go up because supply chains are interrupted, food prices go up. So really, those are 2 areas that I'm keenly investing in. And what I do mostly is, I'm going to come back to this real estate. What I do mostly is just to invest in ETFs a lot. Even though I I buy some individual stocks, but the easiest entry is really just to invest in ETFs. I'm bullish on AI, artificial intelligence ETFs, simply because the world is going in that direction. And when you look at the year-to-date performance of some of the top AI ETFs, you can see that the returns are the performance is very interesting. And then I just do the S&P 500. So really just benchmarking the S&P 500, which is the top 500 shares on the stock exchange, the US stock exchange by market capitalization. Again, when you look at the 12-month performance, it's just a medium risk investment vehicle where you're not having to think of, the individual stocks to buy. It's long term. You can just keep it for the next 5 years. So it's just a place where if you really don't want to do a lot of work, you can just do a direct debit and just buy, a certain amount every month and really just forget about it till the end of the year. So those are some of the things I invest in. I do a lot of commodities, like I said. So this is an index. Sometimes I do individual commodities and sometimes I do index funds. But then again, just to show you what the potential is, particularly when the world is at war. And scripture tells us we're still going to have more wars and rumors of wars. So commodities are always going to be interesting anytime the world is in crisis. So that's my reasoning, behind investing in commodities. I wanted to talk through real estate. Real estate is a safe haven for me. So it's not really a primary investment vehicle because I'm not a real estate entrepreneur. So I'm not the type to flip houses, and that's entrepreneurship. That's not investing. So because I'm not a real estate entrepreneur, I use it as a safe haven. It's just a store of value, and then I unlock the capital through mortgages. So you can refinance your house so that you're unlocking the capital. The capital is not a sunk cost. But you unlock the capital and you can use that capital for other investments. And then the return on those other investments will service the financing or the mortgage. So that's a way to unlock capital if you have real estate and you're looking for seed capital to invest. Real estate, for those who do real estate entrepreneurship, there are higher margins in development and financing. So if you happen to participate in a real estate development, you could earn as much as 40% return on investment in USD, but you're getting in at the development side, and there are a lot of real estate developers that are looking for financing. So really, this is what I'm looking at in terms of just investing. And I'm going to just stop here and just open the floor to questions. Please feel free to ask me anything in terms of what you want to learn, how I can help you with your journey to financial independence. But to summarize, you need to start. You need to really just go through the first 3 steps where you define why do you want to invest, why do you want to become financially independent, what is your reason, because that then tells me the sort of plan that should be designed for you. And then a lot of those variables, risk profile, your objective, your time frame, and then do you have the seed capital? So somebody's asking, how did you know when? So financial independence means that the returns on your investment can take care of your daily expenses. So you're not having to use your salary to pay for basic expenses. You're not having to use your business income because you already have an investment portfolio that can take care of things like rent, transportation, logistics, like all the day-to-day things that you would spend your salary on. Your investment portfolio the returns without touching the capital can actually just take care of those sort of monthly or annual expenses, maybe with the exception of big ticket items like maybe a car, or rent, or but at least your basic expenses can be taken care of with your returns, the returns on your investment. So that's what financial independence means. So if you were to ever stop working, can you survive? That's a simpler way to put it. If you didn't go to work for 3 months, can you actually survive and all your bills will be paid and things like that? Okay. Let me check the chats. I don't think it's open here. Okay. Yeah. So questions. And if anyone wants to, because I can't see the gallery view, so please just feel free
let me change to the gallery view.
Okay. Oh, okay. So if you have questions or you want to unmute yourself and just ask, please go ahead.
Hi, Subomi.
Hi.
Sorry.
Hi, thanks for doing that. Question, please, is what's the difference between the ETFs and the index funds? Because I've
So
always
they're
been,
basically the same. Basically the same. It's just that one is traded more dynamically than the other. But it's basically, if you use an ETF or an index fund, it's basically the same.
Okay, that's not different. And then for real estate, sorry, it was a bit noisy when we were talking about real estate. If you're not buying houses, and I think you said you're not a real estate entrepreneur, so what exactly do you do in real estate?
So what I do is real estate development. So I do financing. So real estate developers that are looking for financing. And once the project is done, because most real estate projects are done within 12 to 18 months.
Yeah.
So once the project is done and sold, I then just get a return. So it's a profit share. So which is why the margins are higher. You're not getting a return. You're actually sharing the profits. So usually the structure around that is you form a joint venture with a developer. The asset is put into the joint venture. So the asset becomes the security and the collateral. So the asset is put into the JV. And then once the project is done, of course, you kind of exit that JV, get your profit share, and you move on to the next sort of 12 to 18 month project.
So what you're describing is high value kind of development. You must have a lot of cash to be able to do that.
Sometimes you can pool the cash. So if you have friends, remember what I said, if you have a tribe, you can actually just have friends and family come together, or you can set up, an investment club, with people in your network, and you actually just pool the funds together. But again, it requires a bit of expertise because you then need to consult a proper, real estate lawyer, be sure that all the documentation is right. I would never suggest you do it in a jurisdiction that does not respect law and order. So do it in a jurisdiction where contracts are actually respected, so that if anything goes wrong, at least you can go to court and it will be adjudicated within a defined time frame. So but it's a good way of doing real estate because you're just getting the profit share, the higher margins, but it just requires a lot more work, not just legal, but also, getting a real estate expert to run the numbers for you, look at the potential of the area, like just all of those things that are required. Yeah.
One last question before I shut up. Have you found, because obviously what you're describing, it has to be somebody who has done this before, who is somebody you can trust, and all those lovely things. How have you found the people you have worked with?
What sort of people?
The developers. Because
okay.
You are not the one doing the hands-on. Yeah.
Usually referrals. So you typically find maybe a friend is trying to, pull together money for, maybe they have land, and they're trying to pull together money to develop. So usually it's, referral, sometimes conferences, like when you attend maybe real estate conferences, there's some industry events, and you kind of see all the professionals in the room, and people will be talking about, deals and things like that. So sometimes it could just be maybe a conference you attend, but mostly referrals. Maybe your lawyer might also have, some referrals. So if you talk to a real estate lawyer, they kind of see so many deals. So they might even just tell you, oh, I'll match you with someone who is looking for funding. Obviously, when interest rates are very low, most developers won't need external financing because they can just go to the bank, and get the financing. But usually this sort of opportunities happen when, interest rates are really high and, people are struggling to raise financing, and they then just look to private, capital for that.
Okay, thanks. Thank you. There are a couple of questions.
Yes. So ETFs, do you get your returns via dividends or liquidating, depending on the ETF? So there are some dividend ETFs. So if you invest in an ETF that such that the constituent stocks are dividend-paying stocks, then you'll get dividends. So depending on what you want, but if it's not a dividend-paying stock, you just liquidate. So you can determine whether you want to liquidate at the end of the year, if maybe your returns expectations have gotten to, you know, that point. So maybe your target was 20% in USD, and at the end of the year, you've already hit your 20%. At that point, you can decide, oh, I'm liquidating, but it's just that you then pay your capital gains tax and things like that. So that's why, you know, you always just talk to a tax professional who would kind of guide you on maybe the best way to structure some of your investments, so you're not just paying taxes anyhow. Let me see, finding people trust, I think I talked about that. So in terms of building your tribe and finding people you can trust, so what we did was we put a fund manager in the middle of our investment club. Because we started out as friends and family, maybe about 300 people, and then people started bringing like colleagues, people we didn't know, you know, who were strangers. And at the end of the day, we grew to about 3,000. But what we did was just to put a SEC licensed fund manager in the middle, and we've done that with about 3 investment clubs now. So what that does is that you have an honest arbiter in the middle. You have a professional that has a fiduciary responsibility to every single member. So they're supposed to be like the unbiased umpire, so to speak, and provide you with professional investment advice. Because sometimes they would even tell you the assets to buy. You know, they're the ones who will kind of do this investment planning for your tribe. And then after that investment planning session, they will take you through, oh, these are the assets that fit, you know, what you guys are trying to do. They'll help you review a lot of investment opportunities before you then get your lawyer to maybe just do the final review. But that's just the benefit of just getting a fund manager in the middle of your investment club. So one of the things I do is to help people who want to design their investment club. I kind of listen to you, have a session with you, and then based on that, I can help you structure your investment club. So do you work with only accredited investors, or is there an amount for entry? So depending on what you're asking. So for example, for the investment club, because it's a retail investment club, you don't need to be an accredited investor, and it's a closed and private friends and family club. So you don't need to be an accredited investor to join an investment club. So whether it's my investment club or any investment club that you set up, as long as it's people that have something in common and you've all agreed, you know, to pull your monies together to invest, you don't need to be an accredited investor. But the beauty about setting up an investment club is that in some jurisdictions, the investment club itself is treated as an accredited investor, because by the time you pull your monies together and you have a minimum of maybe $1 million, the investment club, because it's a legal entity, it could be an LLC, you know, whatever it is, because it's a legal entity and it already meets the requirements for being an accredited investor, it will be treated, even though the individual members are not accredited investors, the company itself will be treated as an accredited investor, and that opens you up to, like, you know, so many deals and opportunities that you may not be able to access as an individual. So questions, please feel free if you want to unmute. You can go ahead, and I'm reading through the chat just to be sure that I didn't miss anything. Okay, yes, I think I'm up to date. So any other questions, please feel free to ask about anything.
Yes, I wanted to ask about the 5K USD seed for capital you mentioned. Is that for, I think I kind of missed it when you mentioned it. Is that for those in their 40s or those in their 30s? Because I think you said.
So I was saying once you're like in your 30s, try to build that as the investment amount, because when you're in your 20s, you can do smaller amounts because you have maybe like 20 years that you can compound over time. But I think once you hit 30, it's good to start with a significant amount, and ideally top it up every year. So, you know, which is why I'm suggesting maybe your tax refund, maybe your bonus at work, like all those seasons when you get huge capital, just your mind, turn that into investment money. Like anytime any huge money comes into your hands, don't spend it. Just please take that into your, because there are not that many opportunities for you to make like huge capital. So you might as well just use it, you know, very quickly. as investment income. And then over the next maybe 5 to 10 years, you start seeing the returns. So all the things you didn't do, all the sacrifices, you made, all the deferred gratification, you then can enjoy that because you did what you needed to do at some point in your life, and then you're now financially free.
Just wondering, is the 5K enough for those in their 40s, or should it be more?
Well, it's a starting point. I'm trying to be modest.
Okay. I'm just wondering. I mean, if one hasn't had any investments, I mean.
Yeah, it's just a starting point, at least to give you a boost.
Right. Okay.
So once you start, then it becomes easier to kind of build. And you can be as aggressive as you want, because seed capital comes, from different places. So for example, one of the major amounts that I used at the beginning of my wealth journey was my housing allowance. I had a paid employment then. And I had this housing allowance that I hadn't taken for like 5 years. So because I was living with my parents at the time, and then when I left my parents' house, I moved in with my sister. So I wasn't paying rent for like 5 years, and I had this bonus that was just kind of accruing over 5 years. And I decided at that point, I had to make a choice. Do I want to leave my sister's house to go get a place of my own, or do I want to invest the money? And I chose to invest the money. So sometimes your seed capital can come from different sources, but anytime you just have like bulk money, it's good to just invest it.
Thanks.
Okay, let me just check.
There's a question, I think, actually 2 questions there.
What mistakes should one look out for when building an investment club? And then I think there's somebody who asked what is required. So, I mean, to join my tribe, just send me a message. I can send you the link. But I think the mistakes that people make is, like I said, not getting an independent party in the middle. And that independent party ideally should be a registered fund manager. Because you need someone who is objective. You need someone who is a professional, who has a fiduciary duty to every single person. You will pay fees. So a typical fund manager will charge maybe 1 to 2% of your assets under management. But I feel that that's a small price to pay for safety. And that's a small price to pay for avoiding fights, and obviously your investment club should have bylaws, everyone should kind of sign to the bylaws and things like that. So usually the mistakes are just not, being structured and not documenting things and usually maybe trying to do too many things with the investment club. So for example, if it's real estate you want to do together, don't add anything else, to that particular entity. You can set up another entity for something else in future, unless you guys are really close and you're not, going to have any sort of dispute. But if you're dealing with people that you're not really, really close with, I would say just limit each coming together to a particular project. See how you work, see what the dynamics are, make it ease of entry and exit. So the good thing about an investment club is you can drop off at any time. Like if you don't want to do again, like there's ease of entry and exit. So that way you don't need to break the entity if someone says they don't want to do again. The person just exits, you just remove their name and continue with your investment club. So those are some of the mistakes I think people make. And then in terms of how you want to, if you want to join my tribe, just send me a message and I'll give you the details. Jolomi, I think your hand is up. Please feel free to unmute. I think because we don't have too many questions, you can unmute when you like.
Yeah, that's Orisha Jolomi. Thank you. So I just wanted to ask, at the beginning of your talk, you mentioned that it's good to, when you want to form an investment club, it's good to have it in a place where, there's jurisdiction, that there is, where they obey the laws of what you have done and all of that. And then 2, would you have any experience probably in Nigeria? And then if so, how did you go about it? And then have you ever been burned, or have you had a bad experience with investing in Nigeria? And then how did you go about it in getting your funds? Thank you.
Oh, yes. My first investment club was in Nigeria. In fact, it's still running. And it's one of the primary vehicles that we kind of use, particularly for Africans in the diaspora who don't want to pay capital gain. Because if you invest in an investment club in Nigeria, for example, and you happen to be a Nigerian in diaspora, you actually don't pay tax in Nigeria. So it's a very good structure for those who want to just keep building the income without paying capital gains tax. And then by the time you bring it back to the US, of course, you pay your taxes. But in Nigeria, it's actually legal not to pay capital gains tax on an investment club. It's known as a cooperative. So for a cooperative, you don't pay capital gains tax. So it's just a pretty good structure for Nigerians in the diaspora. So yes, we've been burnt, which was why we kind of changed the structure to put a SEC licensed asset manager in the middle. And what we've also done is to get a global fund license. So that way our monies are not subject to currency risk. We don't have all our funds in Nigeria. We can invest globally, even though at the end of the day, the monies can still come back to Nigeria if we don't want to pay the capital gains tax. But really it's just to abide by those principles, use professionals. Do your due diligence as well. So for every deal that we do, we actually do independent due diligence. And we've learned to do due diligence, not just using a Nigerian firm, because we find that people sometimes forge documentation and things like that. So also just doing due diligence, looking at global lists, media reports, things like that might be a bit harder to hide. But if you use professionals, chances, because when people say they've been burnt, there was a conference I was in, and the person said, but MTN is still doing business, Coca-Cola is still doing business, Shell is still doing, like there are a lot of multinationals that are still doing business in Africa, and a lot of times it's because of the structure that they put around themselves to protect themselves. So usually I would say if you want to do real estate in Africa, use a professional. Don't use your cousin or your friend or your sister. Use a professional, because that way it actually just really protects you from you're not hearing stories that touch, so just use professionals, and try not to work with, try to invest directly and not through third parties. So that there are no stories. So if, for example, you want to invest in equities in Nigeria, so let me just give you, share my screen. I think it might still be open. Just give me a moment. I just want to show you some of the equities returns. So even though it has, there's dollar devaluation and all of that, but at least it will just give you an idea of, some of the potential of the stock market in Africa. So I'm going to share my screen. So if you look at this, is Stanbic IBTC, their most recent fund performance. You'll see that for banking, so they have an ETF that comprises banking, industrials, and telecoms. You can see in 2023, it did a 71% return on investment. And then I think they have one that is mostly just telecoms, did about 54%. Then there was one that was just banking that I saw that was very interesting. Did about 25. And even the dollar fund, let me see what the return was. Not very impressive, 7.3. You can get better with a US, ETF. So I wouldn't do a dollar fund in Nigeria. So it's so even in Nigeria, if you have spare Naira that you're not using, there are still opportunities that are available, but through professionals. So I would use a professional asset manager. I would use a professional real estate developer. Like, I'm not giving money to any third party. Like, I must hold you and I must be the one doing the investment myself, not through anyone, so that at least I'm in control of the process. So that's what I would advise. Try not to get into litigation, because once you get into litigation, it can take years, to adjudicate. So it's better not to even get into litigation at all, by avoiding. Yeah, go ahead.
Because I have an experience where I did an investment in Nigeria, and my money is, and then I did it directly, and it's through, it's a reputable, well, I won't say reputable, it's a known name, an unknown organization. They have their structure, they have anything. But at the end of the day, they have refused to, or they did not, keep to the ends of, they did not keep to their bargains, to their own end of the deal. And I'm looking towards litigation. Even though it's going to take years, I'm willing to do that because, I mean, I mean,
it's your right, definitely, to pursue litigation. I mean, it's really just unfortunate, which is why I think a lot more people in Nigeria may be investing through, SEC licensed institutions, and that's because the SEC has its own court. So if you have any disputes with a SEC licensed institution, it bypasses the regular court system, and there are timelines for adjudication. So you know exactly when you're going to get your results. So sometimes it's just a bit unfortunate. So it's one of the reasons why I would say, even if you're not investing in a maybe a security that is SEC licensed, still get a SEC licensed fund manager to advise on the deal, because they have a fiduciary responsibility to make sure that they give you the right advice, and they can lose their license if they give you the wrong, if they give you biased advice, so to speak. So I would say that, but if you're going to do litigation, typically I would say don't make it a civil case, make it a criminal case. It's faster, so if there's any sort of criminal elements, in that sort of case, please, talk to your lawyer, but it's usually faster if you make it a criminal case and not a civil case. Okay?
Okay, thank you. Yeah.
Any other questions? There's a lot of money to be made in 2024. I think for those who want to really become financially independent, the opportunities are there. But like I said, make up your mind, why do you want to create wealth? Prepare your seed capital, determine how you're going to fund that investment from year to year. So, have some sort of income or savings that you're setting aside, so that every year you're topping up that investment. Make sure you have at least some medium time frame, 5 years. You're not spending the returns, you're actually just kind of compounding it from year to year for at least 5 years. I think if you have all of those elements in place, knowing your risk profile, if you have a low risk profile, please don't invest in anything that is high risk. It might take you longer to build the wealth, but at least you have peace of mind. Just those basic principles, I think, would help you. And usually I tell people that it takes about 5 to 10 years to achieve financial independence. So you might as well start early, unless you're a trust fund baby, and somebody is going to leave you an inheritance very soon. I think it takes maybe 5 to 10 years to develop wealth. So please, start as early as you can. Okay. Any other questions? Please go ahead and unmute if you want to, or use the chat box. I know I've run out of time.
I don't know if it's worth bringing this topic question. Someone had sent this to me, and wanted to hear your thoughts on this, especially when it comes to investing and the idea of black tax. How did you manage to handle that in your case? I mean,
so what I did was, I had a certain percentage of money that I assigned to philanthropy and giving. Once that money is finished, I say no with my chest. So unless you're dying, and I must see evidence of your imminent death, it must be critical health related challenges, or something like that. But if it's not like a critical health challenge, typically I just say no. So I have that budget, and once that budget is reached, really, you can't blackmail me with my own money. So I think that's the only kind of answer that I can give.
So I guess when it comes to financial independence, I mean, critical to that is having a budget, isn't it? I mean, that should be fundamental before you start anything.
Definitely.
So on that note,
yeah, go ahead.
So on that note, I mean, how do you tell? I mean, you said financial independence is when your return on investment, able to take care of your regular needs. What if your needs increase over time? I mean, how
then
do you
your investments increase? You have to increase.
So it's possible to come out of financial independence in that sense.
Oh yes,
okay. It's not like once you get it,
so if your
you're in
tastes
it.
change, like if your tastes become more expensive and things
inflation.
like that. Yes, inflation. It could even be a recession. Like anything can kind of take out your investments, which is why people tend to use real estate as a safe haven. So it's just a store of value, because with real estate, even if there's a recession, in 5 years, it bounces back. So people tend to just kind of have real estate as some assets that they use as a store of wealth. You're right about the budgeting, because once you have a budget, you kind of know this is for giving, this is for philanthropy, this is for investments, this is for feeding or my home expenses. So that way you can track, because even at the end of the year, a lot of these budgeting apps will give you like a pie chart. They'll give you all the charts and graphs, and you can actually see, what percentage of my money went into house rent, what percentage of my money went into investment. And it tells you whether you've been a good steward. So when you look at the pie chart for giving, for example, if you're very stingy, it will become clear, you at the pie chart. So I think budgeting is good, just to at least help you track what is important to you per time. And it keeps you disciplined, because once the budget is gone, that's it. Like you're not spending anything else, unless you want to transfer maybe from an item where you didn't spend a lot and you have a surplus, and then you just want to transfer it, to that to that budget. Yes, someone said reduce expenses by moving to a cheaper location. Oh yeah, so I shared the experience of how I was living with my parents, and then eventually moved in with my sister to save on accommodation expenses. So sometimes if you get a free space, you can actually take that free space. If your parents are not driving you out of the house, sometimes you can just stay there, or move in with a friend, or just kind of meant different country. So yes, definitely moving to a cheaper cheaper country, that works, especially if the tax burden is not as high, and the cost of living, the cost of food, just basic things that ideally should not really factor that heavily in your budget. So please, if that works, I know it might require a bit more because it's relocation, but if that will help you attain financial independence, then by all means look into that.
Hi, Subomi. Thanks for sharing this. I've been a member of Volition since 2017, so I can testify. I never lost any money. I'm glad that you took this session. My question is this. So I relocated from Nigeria in 2019 and came here. It took me a while to understand the financial system here and all of that, given I was telling Gabriel just before the meeting started that, in Nigeria, we were used to, investing in treasury bills, fixed deposit, you get 17%, you don't do any work, you just, money just grows and all of that. So I started self-directed investing about 2-3 years ago. I've burnt my fingers.
Wow.
The question I want to ask is about portfolio rebalancing and what should an ideal portfolio be? I've made mistakes. I've learned from some of the mistakes, but sometimes I get too scared to go back. I just leave it as it is. I know that's not the best. What should an ideal portfolio be? How many stocks or ETFs should you have? Let's say, for example, I'm just giving an example. You have $10,000 and it's in a self-directed portfolio. You want it to grow. Should you have 10, stocks and ETFs and all of that, or 25% split across different sectors? Or what is the ideal, what is recommended? I watched a lot of YouTube videos from different people. I learned in a very scattered way, And yeah, but I'm learning, I'm still growing. And then I also wanted you to, give recommendations, things that helped you along the way in your self-directed, because that's what I'm doing now with all the funds with my kids' education, my savings that I'm trying to grow, so that I can make some good decisions. Thank you.
That question is a custom question because, like I said, it depends on risk profile, time frame, investment objective, even investment knowledge. What do you know? So I would say that I can give you an answer based on my portfolio. But I think for every single person, you do need to go through that investment planning process where you answer those questions. And then based on that, a financial professional kind of helps you. And like I said, some of those investment planning sessions are free. You can get them, most in asset management companies will give you like a free 30-minute session. I think we do that as well in our company. So if anyone wants a free 30-minute session, you can also just inbox me as well. So back to the question, what I have in my portfolio, I have a base. So I'm no longer as high risk as I used to be. When I was younger, I was very, very high risk. So I did a lot of, high risk investments. Now I'm trying to preserve my income. Like I feel like I don't want to lose any money right now. So definitely I have a base of ETFs, which is really just long-term. I look at it every year. If it meets my investment objectives, I liquidate if I don't mind the capital gains tax. So it's almost like a lazy way to invest in stocks because I love, cutting edge technologies. I'm doing, AI ETFs because I kind of know where the industry is going over the next 5 years. So the advantage with being a fund manager is you get a lot of investment reports. So you have access to data that the general public wouldn't have access to. So I do AI ETFs, then the general S&P 500, which is just safe, is a lazy way, just set up your direct debit. So maybe about 20% of my portfolio would, just go to like ETFs, and that's kind of running. And then I have significant amount of monies in my company because we're a fund manager. So I might as well manage my own money myself, through my structure. So maybe about 50% of my funds go to the volition structure because we then have professional fund managers and that's their job. They just send me a report every month. And of course, they have whatever it is they're investing in the background. But they have my risk profile. They know what my return expectation is. They know my time frame. And based on that, they've developed a custom plan for me. So maybe about 50% kind of goes into that. And then, so that's 70, right? I have some real estate. I've not done a lot of real estate because for me, I just don't like money sitting down in an asset, and I don't want to go through the trouble of refinancing. Like I just left it. So maybe about another 10% is in real estate. And also, so real estate development for me, I see it more as trading because they're kind of one-off. I don't see it as a permanent part of my portfolio because it's really just opportunistic. If I come across a development, I'm there for 12 months, I exit. So it's not really part of my portfolio. It's just anytime an opportunity comes, if I have loose cash, I then just invest in a development. And then maybe the rest of my portfolio goes to cryptocurrencies. And that's because I used to be a trader. So I used to day trade. I understand the market. And so I have some monies that I'm just kind of putting in cryptocurrency for the long term. So that's really what my portfolio looks like. I hope that helps. But do a custom, let someone just design a custom financial plan for you. And then based on that, you can execute. And once they design the plan, they'll tell you the asset classes. So they'll give you examples of the asset classes. So it's not just designing the plan, but once the plan is designed, what asset classes align with the plan. So that's it really. And like I said, if anybody wants to reach out for a free 30-minute investment planning session. I'll just share my Calendly. I don't know whether to do that here or in the WhatsApp group. And then also, if you want to learn about the investment club, also just message me. I'll send you the link as well. Thanks.
Hello,
Hi,
Subomi. I have a question.
Okay, please go ahead.
I would understand why you would be bullish about commodities. But I was also wondering why you didn't say anything about gold, silver, rare materials, and all of that.
Yeah, those are commodities as well. They're grouped.
Oh, you group them, or you under commodities? Okay.
Yeah, they're usually grouped under commodities.
Well, because for me, I would usually, because they're more speculative, I would usually just put them in a different bucket and watch how things pan out. Okay, so I just wanted to be sure.
Yeah, I mean, people even invest in bags. I mean, Gucci bags have increased in value year on year for the last 10 years. So people invest in all sorts of things. I've noticed. So you never know the resale value of your Gucci bag. So yeah. It's just the only thing about gold is if you trade gold on a commodities exchange, it's usually easier because you don't need to think about storage and things like that, insurance. I know there are companies that would help you store your gold as well. But if you maybe just trade it on the commodities exchange, then you don't need to, really think about anything else beyond the tradable value. Yeah.
One question from Subomi is there are quite a number of people who have great ideas and are actually going to start those ideas. So like your startups, scale-ups, all those kind of people.
Yeah.
What is the best way to tap into that market? Is it through the tribe, or are there other avenues to tap into that space? And as always,
Is it venture funding you're talking about?
Yeah, maybe venture funding is the best one.
Okay. Well, I don't do venture funding. I do project finance. And that's because venture funding is high risk for me because I'm not in control of the business. Especially in a jurisdiction where you can't enforce a contract. So usually I wouldn't do venture funding in any jurisdiction where there's no law and order. And even in jurisdictions where there's law and order, we saw what happened to WeWork. So it's possible that you do venture funding in the US and still get burnt, but at least there's some, So I typically won't do venture funding. I've been burnt in Africa simply because the people decided to use the money to fund their lifestyle instead of in the business. And it's hard to govern because all you see is maybe the reports, the quarterly investors report. You don't see management accounts. So, but with project finance, you see management accounts every month. You have a project officer assigned to the project. You have a bank account that you're monitoring. You have access to the bank account. So with project finance, it's a bit easier for me to kind of put money in because I know I can appoint the CFO to that project. So there are a lot of like different
checks and balances.
Yes. And project finance is dated 12 to 18 months. I'm out. Because even for the real estate projects, like I said, because it's a joint venture, you can see the accounts. Because until that development is sold, you're part of the SPV. So you see everything, the money flows, the accounts, like you're part of the project. And then when the JV is dissolved, everybody kind of goes back to their business. So I love project finance because of that level of detail and transparency. I wouldn't do venture funding.
How you've explained it now makes sense. Thanks.
Subomi, there's a question from Oluwatobi Loba. Do you want to take that on the chat?
Looking for it. Okay, which do you consider the best way to begin investing? I wouldn't say a self-directed approach unless you're willing to do the hard work. So some people don't like numbers, some people don't like spreadsheets, like you get overwhelmed. So if you don't have that discipline to, do the learning, do the investing yourself, like every month, you're constantly checking, If you don't have time, I would say don't do a self-directed approach. Just, join an investment club or do a mutual fund, if it's in Africa, or an index fund or ETF, if it's in the West. So that way you're not thinking about it. Just set up your direct debit and just start investing. But if you have time and if you have discipline, oh yeah, because the margins are higher. If you do a self-directed investment, you're not paying a broker a lot of times. All the margins are yours. But if you don't have that time, then maybe just work with either an asset management company or set up an investment club, or join an existing investment club and let them do it for you. And then someone said, what advice would you give someone who is very much advanced in their financial independence journey with a decent stock portfolio but wants to accelerate things? Yeah, so this is a beautiful place to be. This is a wonderful problem that you already are far advanced and you just want to accelerate. So I would say, again, sit down with an investment advisor so they kind of see the constituent parts of your portfolio, get a sense of your exposure to stocks. How do they even preserve your value? Because stocks are high risk. If anything happens to the US economy, for example, your stocks are going to plunge for the next maybe 2 to 3 years until the cycle kind of reverses again. So you want to just be sure you're not overexposed to maybe individual stocks. How do we lock in that value? And then once we lock in that value, what else can you diversify to such that you're accelerating? So it may be that you already have the capital for real estate development, for example. So if you're already advanced in your financial independence journey, you might want to do something low risk like real estate, so that way you're just diversifying your investments, because stocks are already high risk. So I wouldn't advise anything else that is high risk. I would say if you're going to diversify, do something that will give you high margins, but the risk profile is relatively low. Okay. Bonds, no, I'm not going to do bonds. Why should I give my money to a government at 4%? And then the African bonds that are giving about 20-something%, corporate bonds give about 16%. But again, depending on the jurisdiction. And this is USD, by the way. So most emerging market government bonds will give you about maybe between 15 to 20%. And then the corporate bond will, there are some USD corporate bonds that will give you about 16% per annum. But if it's just a basic sort of money markets instrument that's going to give you like 4%, then it doesn't make sense. So really it's just to kind of sit down with an investment professional, let them give you a list. Usually they'll give you a list of the bonds that are available. They usually have a spreadsheet where they will calculate the yield for you year on year. So if it's a 5-year bond, they'll calculate the yield. So make sure they give you that spreadsheet, because that spreadsheet is what you're going to use to arrive at a financial decision. So if you just talk to, walk into an asset management company, because they are the ones that typically would sell bonds, they can actually just give you the options, and they'll do the analysis for you as well. So it's really just, very, very simple. Just avoid any government that you feel is going to default. So when you're looking at government bonds, if there's any government that looks suspicious, just avoid them, please. UK, I'm not familiar with investing in the UK, so my jurisdictions are the US and Africa. So I've not done a lot of research, unless you explain what it is, and if there's a US equivalent, then I can get a sense of what it is. Okay. I think this is it. So unless anybody has any other question, I think I'm done. Okay, there's one more. What is the average percentage one should be looking at for returns? Again, depends on your risk profile. So if your risk profile is low, you're never going to get anything more than 8% in USD per annum. So I would say you must have made your money first, and maybe now you're trying to protect it. So you just want to do very safe, easy, principal guaranteed instruments. You don't even want to take risk at all. So usually for a low risk profile, I would say about 8% in USD. For medium risk, where maybe your risk exposure is about maybe 20% of your capital, you're willing to risk 20% of your capital. So medium risk, usually you can get between 15 to 20% per annum. And if you compound that, of course, the annualized rate will be higher. For high risk, again, depending, high risk is 50-50. There's a 50% chance you may lose your money. So I would say limit your high risk exposure. Don't put more than 10% of your investment capital into anything that is high risk. Unless you're a financial professional and that's your day job, so you kind of know how to balance the risk. For high risk investments, 50-50, like I said, sometimes you get as high as 100% per annum. There's no cap, so for a high risk investment, what you're trying to do is you want to get the maximum possible value, but you're also willing to risk the maximum possible loss. So it's a 50-50 chance of either making a lot of money or losing all your money. So high risk, there's no cap. You can, I've seen people do 3,000% on cryptocurrency. So there's no cap, but also you can lose that money in 24 hours. So just be guided, please. Yes, so I think I'm done. For the UK question, like I said, if you maybe explain what it is, I can look for an equivalent in the US to explain it.
Yeah, I think the question on can you shed more light on ISA in the UK? The ISA is similar to what's it called? Basically the
okay, Roth RI.
The Roth RI, yeah, that's something like that. It's similar to that. So
okay.
it's tax free until you take it out. I think it's at age 55 or thereabouts. Yeah. Or if you don't take it out before age 55, it's tax free. Yeah.
Okay, yeah, so that would be like a retirement account, and because it's tax free, you want to just maximize it. Maybe put the maximum you can, especially if your company is going to match it. I know in the US we have 401ks, so if your company is going to match it, then sometimes it's good to just put the maximum amount so you can get your company share, so that way you maximize it. But it's not a high return investment. It's not like it's going to make you rich, but it's going to help you with your retirement planning because it's tax-free. So in the US, I would recommend a universal life insurance plan. And like I said, you can DM me for that because it tracks the S&P 500. So you have that extra earnings, that extra boost, that you would get from an ETF, and it's also principal guaranteed. And then you can borrow from it. So in the US, we have this thing called, be your own bank. So instead of borrowing from the bank, borrow from yourself, and pay yourself the interest. So that's what people use the universal life insurance plan for. So I would recommend that yes, maximize if you have any sort of tax-free investment, especially if your company is going to match it. Maximize it because it's useful for retirement. It's not money you're going to use now. So you're just putting it away for retirement. But once you've maxed out on that, then focus on what is going to really accelerate your wealth, because that money is not going to create any sort of wealth. It's just a buffer, soft landing when you retire.
Maybe let me chip in a bit on the ISAs, because I'm in UK and I use them. I think it's slightly different from the way Roth IRA. I know it's tax-free. I don't have the details of Roth IRA, but the way ISA works here, it's an account anybody can open at any time. You have an allowance of up to £20,000 a year that you can invest tax-free. And there are different types. So there's some that you can invest in stocks and shares, just regular stocks and shares, like anything. But all your returns are tax-free. And you can take your money anytime. So it's actually a very useful vehicle. What you described in terms of the one that you have to wait till you retire, I think that's they call it a SIP here. It's
Okay.
a type of a pension that you can put your money in, but that one you have to wait till you retire. So the UK here, they have different types of accounts like that you can actually play with. But I think the ISA is actually very beneficial because you can put your money in there and invest in the stock market through it, and everything will be tax-free. And you can take the money out anytime.
Oh yeah, that's good. So that's
It's just
almost
that
like
there's a cap of 20K a year. So if you're ready,
so that's
you're
similar
richer
to
than
the
that.
universal life insurance plan where you're building cash value and it's indexed against the stock market. So in the ISA's case, you can choose what you want to index it against and what
Exactly.
you grow it again. So it's similar. I guess the closest will be the universal life insurance plan in the US because that has actual cash value. You can also terminate it at any time, but I think if you terminate it before a certain period, then maybe you paid your capital gains tax and all. So yes, I think that's a good vehicle because you can at least maximize it. Put in the £20,000 that you need to put in if you have more than that in disposable income, and then still have a separate investment plan that is accelerated. So you may just want to do some other things independently. I would use the ISA as at least a base. It's a base. And since you can index it to different things, like you said, if I can do the same thing through a tax-free plan, then I might as well, use the tax-free plan. And then any other thing you want to do that is not covered by, ISA, you can then, have a separate plan for that. So I hope that helps.
Just one quick question, Suzanne. You mentioned the S&P 500, but I don't know. I have a feeling maybe it's like US stocks are already sort of overpriced because like if you look back 30 years ago, they went, I mean, I think it was Japanese stocks that were like this, that were, that made up the bulk of the global funds and all that. So I'm just thinking, wouldn't it make sense to sort of focus more on global funds as opposed to everything just sitting in S&P 500? And, we're hoping that the US continues to grow the way it has been growing for the past 10 years.
Yeah, you can, but the minute you begin to introduce complexity for newbie investors, sometimes it just gets overwhelming. But for someone who maybe has a bit of time to do the research, doesn't mind doing a bit more work, then definitely you might want to check, what's the performance of the global index vis-a-vis the S&P 500? Thankfully, because of ChatGPT and Gemini, former Bard, a lot of the research can be done in natural language format. So you can actually just ask ChatGPT or ask Gemini, and they would, those platforms will give you all the charts and graphs. So I would say do the research. If you find global stocks that perhaps are more stable, and you feel like they might give you the same sort of returns, and you want to minimize your exposure to the US, then please go for it.
Thank you.
Okay. Do we have any more questions before we kind of round up? At least on my end, Gabriel, I don't know if you have any other agenda. Your mute is we can't hear the sound. I think the other device is muted.
Oh, sorry, you're right. I was muted. Yeah. So yeah, I was just wondering if you would be open to setting up an investment club for people within this group, assuming some of us decide that, you know what, we'd like to have something amongst ourselves. Would that be something that you'll be open to do? Of course,
yeah.
I don't want to put you on the spot. So
no, I mean, I can at least give some preliminary advice. I said, I mean, we have a free, 30-minute investment planning that we kind of give people. I could extend it to maybe an hour, just to at least talk you through the process. And you kind of know these are the things, the documents that are required, the things you might need to put in place to set up an investment club. So yes, I can do that.
All right, cool. Thank you.
I think there's no other question from what I can see. I need to drop off because I have another meeting in 10 minutes. So I just need to prep for that meeting. So if you allow me to, please just drop off now.
Yeah. Oh, okay. We'll probably bring the meeting to an end since there are no more questions. So thank you so much, Subomi, for this amazing
Thank you.
walkthrough. I've really enjoyed every bit of it, and I believe everyone has as well. So I think we'll send you, for those who are more interested in knowing more, can send you a message offline. Yep. Okay.
Thanks a lot. Bye-bye.
Yeah, thanks everyone for joining.
You.
We'll bring the session to an end. Okay, thank you. I'll stop recording now.